Hey everybody, it's Wayne Nichols back with another video, and you know my motto is small goals, big victories. Now, among the goals that I have for 2023 is generating cash flow by selling covered calls on a consistent basis against the stocks in which I own 100 shares or more. And one of my favorite stocks to sell covered calls against is the Russell 2000 ETF, stock ticker IWM. Now, some big reasons as to why I love this stock. The first one is they offer options 3 times a week. So some stocks offer weekly, some stocks offer monthly. Some stocks like IWM give you the opportunity to sell covered calls or cash secured puts up to 3 times a week. But what happens when you sell a covered call and that strike price is exceeded and you don't necessarily want to part ways with your 100 shares? Well, as it turns out, I'm in that predicament right now. Today is January 6th, so this call that you're about to see expires in just a few hours, but I repeat, I do not want my shares called away. So we're going to talk about the options that I have and why it's so important that if you are going to sell covered calls, you really have to understand the fundamentals to include how to roll a position. So let's go ahead and just start with some information. I have 100 shares of IWM. My cost basis is $175.95. And I currently have 2 options on IWM. We're going to focus on the covered call. And you can see here that I have a 176 covered call set to expire today on January 6th. Now, if we dive into this transaction, you can see here that I was able to purchase or sell, I should say, this covered call for a premium of $90 just a few days ago. So I am generating, consistent cash flow on a weekly basis, sometimes multiple times a week. So I sold a covered call, I received $90 in premium, and what I essentially said was, listen, I don't think that this stock is going to exceed 176. And if it does exceed 176, then I am agreeing to allow those shares to be called away. We'll go ahead and take a look at the top left-hand pane. You can see the current share price of IWM is 176.98. So that means that I am currently above my strike price, which means in a few hours, unless I do something, these shares are going to be called away from me. So let's talk about the options that I'm going to deploy for this covered call. Now, I've got a couple of options because currently the value of this covered call is $114, right? You see the $1.13, but you have to multiply that by 100 because everything that you are selling options is going to be on a minimum of 100 shares. So right now, I earned $90. If I didn't want to lose my shares, I could simply go ahead and buy back this position. And what I am essentially doing is saying, listen, I received $90, but I don't want to lose my 100 shares, so I'm going to pay back, $117. So I got my premium of 90, but in reality, I'm now upside down in this position. So that is one thing that I could do to close out this position. And if I buy this contract to close, then I'm done. I keep my 100 shares and I can, in essence, wait until tomorrow or next week to sell more covered calls. But I want to talk about the idea of rolling your position. And rolling your position is simultaneously buying to close your current position while simultaneously opening up a new position. Now, there are a few goals when you are rolling the position. And one of those goals is to get a better strike price on a different date and hoping that you also earn extra premium along the way in that transaction. So let's see how this is going to play out. I'm going to go ahead and do this live and see if this works. So right now, again, I earned $90. My strike price is 176. The current price is 176.99. So almost 99 cents above my strike price. Even if it's just 1 penny above my strike price, I am going to have 100 shares of IWM called away from me, and I don't want that to happen. So with just a few hours left in the trading day, I'm going to go ahead and roll this position. Now, I'm using the Robinhood platform. It may look a little different on the web version, or if you're using another brokerage. So let me choose roll my position. And right now it's telling me that I currently would have to pay about $111, right? So that $1.11, you have to multiply that by 100 shares. So right now, I would have to pay about, you can see here, just refresh to $109. And the reason it's refreshing is because the stock price of IWM is slowly falling. So you can see here, as recently as a couple of minutes ago, it got up to 177.81. Now it's falling, I should say, to 176.88. And again, I could wait a few more hours to see if this thing falls back below 176. In that case, I would earn my full premium and the contract would expire worthless. But I think it's pretty interesting to create some content showing how to roll a covered call. So I'm going to go ahead and do just that. So I'm going to go back to my covered call, and you can see here that I'm going to go ahead and roll this position. And right now I would have to pay about $108 to close out this position. But again, I'm rolling. So I am simultaneously choosing a new position. And today is the 6th, which means it's Friday. And as I mentioned before, IWM allows you to sell covered calls 3 days a week, Monday, Wednesday, and Friday. So you can see right off of the bat, it is showing January 9th, right? So this is the position I currently own, the 176. So I want to go ahead and roll this to a future date, but I want to go ahead and see if I can choose a better date and strike price. And I want to see if I can also generate net premium. So right now it's going to cost me $105 to close out this position. And if I were to choose a 177 strike price, I could get paid $102 in premium, which means I'm still at a net loss of about $4 to $5. So I can do a couple things. I can choose a lower strike price, which would get me a higher premium. But if you look at the current strike price in the middle of the screen, right, the current price of IWM is going for 176. So I don't want to choose a position that's lower. And in reality, right, my current 176 covered call, that's why I'm in this predicament, right? The stock has gone above that. So I'm going to go ahead and choose a different date, and I'm going to look at the 11th. Now, there is a 177 call available that would get me $167, which means I would earn additional net premium from this transaction. Or I could even choose the strike price to be 178. By choosing a higher strike price, yes, I am earning less premium, but if the stock truly rises even above 177, right, I still stand a better chance of that transaction not being assigned. So I'm going to go ahead and look at the 13th, and you can see here, this is now 1 week out, and these premiums are a little bit more juicier. So you'll see here there is a 178 covered call position that I can choose. That would be for January 13th, and it would yield me $222 in premium. If you subtract the $104 that it takes for me to close out this position, well, that's going to be about $100 in net premium. So I'm going to go ahead and choose that position. So I'm going to click on the plus, and you'll see here before I click on continuing, it's saying, hey, Wayne, you're going to go ahead and close out your current position. So that's the 176 covered call on January 6th. You're going to go ahead and pay about $100 to close out the position. And in turn, you are going to open up a new position the following week on January 13th for a higher strike price of 178. So I'm going to click on continue. Now, there is always going to be a spread when you are selling covered calls. So by default, it mostly will choose a number directly in the middle. I'm not going to try to change this number. I want this transaction to go through live. So I'm going to click on review, and I'm going to go ahead and submit this order. And let's see if in fact it is filled. Sometimes it may put it in the queue. Sometimes if the price is fluctuating, it may take some time. Sometimes if the price continues to go down or up, right, I might have to go back and edit my existing order. But there you have it, guys. There is the down and dirty on how to roll a covered call on the Robinhood platform. Be sure that you guys, and look at that. Just like that, the transaction executed. And I'm glad I did it for this video. So now let's go back and look at IWM. And you can see the current price of IWM on today's date is 176.75. So I'm still over, right, that 176. If I had just maintained my position, I run the risk of those 100 shares being called away from me. But let's go back to my transactional data. And what you're going to see here is this short call roll transaction. And this spells out exactly what I did. I had a 176 covered call set to expire on January 6th. I bought to close that position. So I paid $99 when it was all said and done to get out of that position. Now, if you remember, originally I earned $90 for that premium. So right now I'm at a net loss of $9. But simultaneously, because I rolled the position, I chose a different date and strike price. So now, January 13th, I have a 178 covered call. And for doing so, I earned a premium of $218. So if you do the math, I've come out about $100+ ahead. In fact, $119. So if you then subtract the $9 that I lost on the first position, right? I'm still listen, I made $110 for less than a couple of days of, obviously having this covered call position. So I'm a big fan of selling covered calls. I'm a firm believer, though, that you have to choose a quality stock and you have to make sure you understand the fundamentals. But hopefully you can see if you are selling covered calls and obviously the stock could bounce up and go above your strike price, there is a way to roll that position. And this is really an important aspect to know about if you, in fact, choose to sell covered calls in 2023. Guys, I didn't mean for that video to go so long, but I thought it was pretty cool that you guys got to see how this thing unfolded live. So thanks for tuning in. We'll see you on the next one.